Would you like to invest in a company quietly cashing in on the unstoppable growth of e-commerce and logistics, and rewarding investors with a 4% dividend yield paid monthly ever since 2013? STAG Industrial might just be an overlooked REIT on the market. But at these mid-$30 levels, is this a smart opportunity or a value trap waiting to snap? Stick around, because by the end of this video, I'll show you what I think STAG is really worth and whether I'm buying it. Overview. STAG Industrial, ticker STAG, is a real estate investment trust, or a REIT, that focuses on acquisition, development, ownership, and operation of single-tenant industrial properties across the United States. Think of warehouses, logistics centers, fulfillment hubs. STAG is riding the tailwind of e-commerce boom and the growing need for last-mile delivery. They own almost 600 buildings in 41 states, renting them out to companies in manufacturing, distribution, and logistics. That tenant diversification lowers risk. No single tenant makes over more than 3% of their revenue. They also diversify within industries, with the biggest being 11% of rent revenue. Now let's talk numbers. Financials. Forward EPS is around $2.50, and the price to FFO ratio sits at around 14.5. STAG pays a $1.49 annual dividend, which yields just over 4% right now. And as I mentioned earlier, it pays monthly, which is a nice bonus. They have paid monthly since 2013, with dividend growth of 13 years in a row. Dividend growth hasn't been amazing, from monthly $11.25 in 2015 to $12.42 now, meaning only 10% growth in 10 years. Short interest is elevated at a nearly 4%, and the company's market cap is just under $7 billion. Over the past year, total returns are flat around 0%, while the 5-year total return is about 50%. For comparison, the S&P 500 returned roughly 110% over the same 5-year span, significantly outperforming STAG. Looking at the revenue per share, the long-term growth has been underwhelming. It took nearly a decade for STAG to grow revenue per share by just $1. That's only about 30% growth in 10 years. However, the total revenue has increased about 60% over the past 5 years, which suggests that there's been a fair bit of dilution along the way. Revenue growth is important, but not as critical for REITs as FFO. FFO has grown roughly 60% in the 5 years, which is solid, but FFO per share has only increased about 30%, which is a much slower pace. The cap shows that STAG hasn't been able to translate its growth into stronger per share value, meaning it's growing but not necessarily becoming more efficient or rewarding shareholders proportionately. That said, growing FFO by 5 to 6% per year is still a respectable pace for a REIT, especially one focused on industrial assets. Future. Let's start with the opportunities. E-commerce growth. As companies like Amazon and Walmart continue expanding their online presence, the need for industrial real estate skyrockets. Last mile logistics. More companies want warehouses closer to urban areas to reduce delivery times. Monthly dividend. STAG pays monthly, not quarterly. That is a bonus for income-focused investors. Risks. Interest rates. REITs are sensitive to interest rate changes. Higher rates equals higher borrowing costs and possible falling share prices. Tenant risk. Since it focuses on single-tenant properties, a default means 100% of that building's income disappears. Now let's move on to the intrinsic value. Let's break it down. STAG's FFO per share is $2.49. Analysts are estimating that growth will accelerate a little in 2026 to between 6 and 8%. STAG has all the headwinds now, but I still feel like not estimating too much above the historical growth. So I'll estimate the conservative growth of 5% for the next 5 years and 3% for the next 5 years after that. And like always, I want 12% for my money. STAG has historically traded at a premium valuation compared to the many other REITs, largely due to its focus on industrial properties and its reliable monthly dividend payments. Its PFFO has typically ranged between 13 and 25, and it currently sits around 14.5. Given the current macro headwinds, I think a PFFO of 14 is fair and conservative multiple for STAG. Using that valuation, we get an estimated intrinsic value of around $34, which is roughly in line with the current market price. So while it's not a screaming buy, it is definitely one to keep an eye on. I don't own it yet, but if it dips below 30, I might consider starting a position. That said, one concern I have is the lack of meaningful dividend growth. For a 4% yield, I'd expect more consistent increases over time. Compare that to a REIT like NNN, which offers a higher yield, over 5%, and better dividend growth, all while being considered extremely safe. If STAG can eventually ramp up its FFO per share growth, that would likely translate into stronger dividend increases. Until then, it remains a solid but not outstanding pick in the REIT space. If you're looking for a monthly income, steady growth, and exposure to the industrial real estate, STAG might be for you. But as of now, I'm not buying it. And remember, do your own research, and this is not financial advice. So what do you think? So is STAG a buy or waiting for a better opportunity stock? Let me know in the comments, and while you're down there, hit the like and subscribe. And as always, do not lose money and safe travels. Bye bye.